Thank you very much. Well, it's a big pleasure to be here at South Summit another year. It's great to see so many familiar faces and this vibrant ecosystem. So yes, as he was saying, my name is Marta Antunes, and I'm the director of Guaira in Barcelona. For the ones that you don't know Guaira, we are part of Telefónica Open Innovation Initiative. We invest in startups that can bring innovation to Telefónica and its customers. We were born 12 years ago, and we have different hubs all around the world, particularly in Spain, UK, Germany, and in different countries in Latin America. And well, I'm very happy to be here today. And we will start introducing our panelists, starting with Payflow. And in fact, we're like very proud investors of Payflow. So yes, if Avi, you can introduce yourself and what you do at Payflow for the few ones that maybe you don't know, they don't know you.
Sure, thank you. So I'm Avi. I'm one of the two co-founders at Payflow. And what we do is we've built a mobile app that allows employees to get paid whenever they want, instead of just once a month. We sell it to companies as an employee benefit in exchange for a SaaS fee, and that's why we're considered a SaaS. And what it allows an employee to do is to withdraw the part of their wages that they've already accrued. So for example, if you're a waiter at Five Guys and you make 1,000 euros a month, then on the 10th of the month, you've already accrued 333 euros, and you could withdraw up to that amount instantly and for free.
Great. And yeah, regarding like also the title of the panel, no, regarding SaaS, some of your competitors, no, when you started, no, had a different model, no, which is more like per use, no, where the user had to pay, no, when they want to withdraw this money. You, on the other hand, no, opted for a SaaS model, no. What made you do this decision, no, and what do you think is the benefits, no, that they're bringing to you?
Sure. So actually, it was a bit of a serendipity because the model we were pursuing had already been pursued by a very large player in the US, a unicorn called DailyPay. And we actually had discovered DailyPay 10 years before we started this startup. The pizza store where we used to order pizzas from when we were living in a fraternity together used to use that app. So when we first started, we thought, well, if it worked for DailyPay in the US, let's do the same. So every time a user wants to withdraw 50 euros or 100 euros of their salary, let's just charge them 5 euros, right? The thing is, once we started to get adoption, once we started to have our first 10, 15 clients, we followed the advice of Y Combinator, which is the accelerator which we belong to, which was talk to your users and listen to them. And we were talking to users, listening to them, and they were saying, the only thing we don't like about your solution is that it has a cost. So that's why we decided, okay, we need to find a solution for it to not have a cost for employees. And it made a lot of sense. SaaS was a great option to go after because it's very hard to remove. It allows you to have very predictable revenue. It allows you to maximize revenue, right? So we decided to try SaaS first, and it clicked. It worked very well, so that was it.
Perfect. We will now introduce the other two panelists, Pascual and Ross. If you can introduce yourselves and what you do at the North Zone and at Adara.
Absolutely. So yeah, thanks for having us. So Pascual, I'm an investor at North Zone. We're a multi-stage venture capital fund. I'm based in London. We've got offices in New York, Berlin, Stockholm, and Amsterdam. And we've been around for about 30 years, currently in our 10th fund, investing out of a $1 billion fund from sort of pre-seed through pre-IPO, so anywhere from sort of 500K to up to 40 million checks. And we're about 20 investors on the team. Each of us has a number of focus areas, but collectively it means we've invested in most. So everything from alternative proteins to autonomous trucks, but really most of what we do is sort of sitting in between those, and often in the form of SaaS and B2B SaaS. Marketplaces and so forth. So we're proud investors in Idoven here in Spain, Wallapop, Microverse, and Redpoint, and hopefully many others. So very happy to be here.
Great. And you, Ross, tell us about yourself.
So I'm a principal at Adara Ventures. We're based here in Madrid. We're early stage. We're investing from our third fund, which is an 80 million euro fund. Focused on enterprise tech. What we say is companies that are solving complex problems for the modern enterprise. In 2023, the modern enterprise can be anything from a football club to a research institute, and even more so now with the proliferation of AI, the market's expanding for what a modern enterprise could be. We've touched quite heavily in the past in deep tech, where you get revenue models that are not always as simplistic as the SaaS model. But we have quite a lot of our portfolio in B2B SaaS. And ironically, our best performing companies have not been SaaS models. So there's a lot of investor appetite to go after SaaS because it's replicable, it's scalable, it's predictable. And when you get it right, you can see early signs of creating category leaders. Some of our best companies have not gone after SaaS models, and they've become very, very big companies. So SaaSing your way to success is one way to do it, but success isn't a linear solution. There's many ways to do it.
For sure, for sure. So talking about success, no, and maybe a question for Pascual, no, that you were saying, no, that you have like a big track record in investing, particularly in SaaS, no. What do you think are like the key factors you see like in your like best performing companies in your portfolio, the things that they cracked in order to scale their businesses and do it in a sustainable way?
Yeah, so I think it obviously varies enormously from different sectors. So maybe to give a few examples, sort of we could talk briefly about Personio, Eidovin, and maybe Spring Health in the US. So on the side of Spring Health, their solution is positioned on towards enterprise. They for those that don't know them, they basically work as a benefit solution where if you're an employer, you can access therapy. And for them, I think a big part of the success is sort of two-pronged. One is making sure that the end user, the employee, is having a good experience. And in that case, a lot of it depends on, are you matching successfully that person to the right therapist? Mm-hmm. And of course, there's data and there's a product component to that, to making sure you're delivering on the experience. But another one actually is a human element. And so having what they call a care navigator, helping you identify who the right person is for you, is actually a huge predictor of success. On the other hand, if we think about maybe a Personio, where it's very much sort of B2B SaaS focused on SMBs, they're cracking the first sort of vertical for them, sort of HR management more broadly, and then becoming indispensable, and from there expanding into other verticals like talent and more recently payroll. So I think there's different ways to go about it. Ultimately, I think a big part of it is just becoming indispensable and solving a clear pain point. But there's different models, and Eidovin, for example, here in Spain, on the sort of deep healthcare side of things, also positioned as SaaS. They're solving such a clear pain point by helping cardiologists screen and diagnose cardiovascular conditions in seconds instead of hours. There's a clear ROI for the healthcare system and for pharma as well. So I think to a large extent we're particularly keen about opportunities where you're solving and delivering value in a very clear way.
Great. On the other hand, Ross, you mentioned that in your case, some of the most performing companies don't necessarily need to be TSS, no? And what do you think are like the main challenges for SaaS startups that they encountered? No, what do you see like some of the problems, no? And also maybe some tips, no, on how maybe some examples of startups that have tried to solve them.
So, regardless of the revenue model, product defensibility is something that we see as a common value driver, right, for a company. Particularly in the early stage when companies are beginning sort of SaaS models, what we see is big mistake that they make is they don't define their ideal customer profile. So they will sell their product to an SME or long tail in the same way that they would try and sell it to a bank. And that loss of focus is obviously consuming resources, consuming time, consuming cost. And when you're in early stage and you're just getting from like seed to Series A, pre-A, and you're trying to find product market fit, you don't typically have a lot of money, right? So you have to really drill in on your ICP because that's where you can start to scale. And that's where this model really pays off, is the replicability. And having ICP means sacrifice. So it means if you decide that your target is an SME, when the bank's open innovation team contacts you and invites you into a sandbox for 3 months, you say no, because even though the outcome might be a $500,000 a year ARR contract, you've defined your ICP for a different type of customer profile. So for us, getting it right, and certainly before we would maybe start to introduce them to North Zone, we'd want to see product market fit, ICP, super replicable, and that's where you start to see the scale in the model, and certainly that's where growth investors look first. They look at the numbers. In the early stage, we're looking more at the vision and the product defensibility, and then the revenue model evolves.
Great. We were talking about scalability, and for me, it has like two parts. First, how you acquire your users, and then how you retain them, and make them like grow, together with your customers, In the case of Payflow, Abby, how do you do this customer acquisition and, more important, also retention of these customers?
Yeah, so in terms of acquisition, exactly as Ross was saying, at the beginning it was pure laser focus. We chose one ICP, which was restaurant industry, and we did only outbound sales. 100% of the team was outbound sales. So we perfected the metrics, and once that had turned into a replicable machine, suddenly you had around 100 clients, and other things started to happen naturally, right? And that pushed you to open other channels. So today, around 40% of our acquisition comes from inbound and marketing. And that usually comes from client referrals. So other Five Guys recommends it to Burger King. From employee referrals, which is an employee from Five Guys goes to work at Grupo La 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 and asks his employer to implement Payflow. And thirdly, just from general marketing, like inbounds coming from like press releases and those kind of things, right? So once you are at a larger stage, I think it does make sense to have multi-channels. We also started developing partnerships, but laser focus at the beginning was key for us. In terms of retention, as Pascual was saying, what you have to do is you have to become indispensable. So how do we become indispensable is different to most SaaS, because most SaaS, the person who buys the product is the person who uses the product. For example, in the case of Personio. But in our case, HR or a CEO might buy the product, and then his employees will use the product, right? Why are we indispensable? Is because once you have 50% of your workforce getting paid every day or 5 times a month instead of just once, who's going to go and tell them, hey, you're going to go back to getting paid once a month, right? So no one ever removes our product. We have a churn of 0.1% per month, which is best in class in SaaS, right?
Great. And then there's another thing that is expansion, right? So doing the same like in different markets, So I don't know if you, from an investor point of view, also like if you've seen like some success stories, of SaaS, starting like this with laser focus, in one like customer profile, one market, and then doing it right, replicating it in other markets. How would you like? So just like in terms of like strategy, of a SaaS company trying to expand into these like international markets or maybe into other products,
Yeah, happy to go first. I think maybe the first question before doing that is sort of understanding what the objective is. So for us, for example, one of the reasons we often can't engage with a certain company is because there's constraints to the market size. And because our fund is a $1 billion fund, and whenever we invest, we sort of expect that each investment has the potential to return the fund. Oftentimes, that requires that companies are participating in different markets. However, there are certain industries or solutions where the local market is more than big enough. And whether that's payroll, there's many other examples, right? And so I think if you've decided that you need to, in fact, go out, I think there's different strategies we've seen. One of the ones that, particularly on the sort of more enterprise side, if you're already working with very big companies that have presence in other countries, that can be a pretty natural transition, where you have champions internally in the company. They can push you to sort of other countries. But I think there's something to be said around sort of, doing trials, making sure it works, and before sort of spending too much money on it. And I think, hiring the right person to really own that country is also important. Not that it's something that's sort of in the backlog and something that you don't really prioritize.
Perfect. No, my question was because at Payflow, no, you've recently expanded, no, into different countries. Maybe you can share also with us how it's been the experience into launching Payflow in LATAM and in Portugal.
Yeah. So as Pascual was saying, it's definitely a challenge to expand, and it always creates a distraction from that laser focus we were talking about initially. In our case, the reason we chose to expand was not because the market in Spain for our product wasn't big enough. It was because we thought the product market fit would be better in Colombia, where the minimum salary is much lower, cost of living is not much lower. And we decided to look for product market fit, stronger product market fit in a different way to what most companies do, which is changing the product. We tried to change the market. And it was a fantastic decision. Today, less than 9 months after we launched Colombia, we grow faster in Colombia than in Spain, with half the team size, a quarter of the burn in salaries. And that's why our expansion strategy has completely changed. And now we choose to focus on Peru and other countries in Latin America.
Great. And changing a little bit like the conversation nowadays, well, for sure there will be like a lot of entrepreneurs right now, no, interested in raising a new round. No, today here we have 2 investors with us, and also you that you have raised a successful round in the last year. And so one of the questions for Ross is first, how do you see the market right now in terms of like investment? And second, what recommendations would you give, no, to a founder, to a SaaS founder that now is looking to raise capital?
So there's a lot written about how the market has changed in the last year, and the sort of the depression in valuation, the depression in revenue multiples, typically coming from the public markets, right, where multiples had got well ahead of themselves. And the way that capital flows into different asset classes, there's a lot written on how fund managers are allocating capital to what is like startup world or venture capital, and how that's going to change. So there's people out there that would sell you this being a very horrible time to go and raise. But in terms of overall volume of capital in venture and for startups, there's never been more capital. So whilst things have slowed down a little bit for founders, I would say that the pure fundamentals, particularly at the early stage, right, in terms of having product differentiation, building a sustainable competitive advantage, bringing a great team together, those are the most important things. It doesn't matter if it's a difficult market or a great market for fundraising. Those are the things that you have to focus on. People get ahead of themselves in terms of valuation and how much they want to raise, etc. You have to adjust to market conditions. So maybe you're going to try and raise a little bit less than previously, and maybe dilution is going to be a little bit more. But those are things that are always flexible levers in any kind of deal. What would I recommend to founders? You have to talk to a lot of people in this market. Fundraising is taking longer. It's more challenging for sure. Investors are taking their time when they're deciding on which new investments to do. I would encourage you to be flexible on the terms, but really be optimistic, because there's never been a better time really to start a company. And certainly at the early stage, perhaps you can give the contrast on the growth picture, but at the early stage, I encourage you to reach out. I mean, we're investing. Come and talk to me.
Great.
We're investing too. No, so I mean, maybe a few contrasts. So I think on one hand, I think deployment has definitely slowed down. So there is a lot of capital in the market, but a lot of funds over-deployed in 2021. So a lot of their assets are priced too high, right? And so there has been a slowdown. If you've been lucky to have raised a fund recently, as we did, there certainly are funds deploying. A couple of things maybe I would say is, one, that things are taking longer is not necessarily a bad thing. Having the time to really, understand if there's a mutual fit is probably not a bad thing, right? You're going to be working together for a long time, and you want to make sure that that's the right partnership. And on the other hand, if you are a good team, you're building a good product. Today, because there's fewer opportunities out there to an extent, those really successful deals are receiving a number of term sheets. They are commanding similar valuations and pricing as a year ago. That may not be the norm as it used to be a year ago, but I would argue that we're reverting back to the norm from a year that was 2021 was absolutely not the norm. So, and then the last thing, particularly on the early stage side, the bar to raise that sort of late seed to Series A might be higher, and so I encourage founders in raising their pre-seed to sort of actually raise as much as it makes sense to get them to that next stage where they can really show sort of that being at an inflection point, whether it's on product, commercially, because it's going to be much easier to raise at that point that at 12, 18 months later when not necessarily many things have changed and you still need more capital.
Great tips. And we're running out of time. I had a lot of questions for you, but I want to present the last one to Abby. You were the winners of last edition of South Summit, and so congratulations for that. And I wanted to ask, what has changed in the last year for Payflow? If you can just tell us a bit what represented a little bit for you, winning that competition, if it had an impact, and then also what has changed a year later that you're again in South Summit.
Sure. So, touching on the points they've just been discussing, the funding environment changed. So that means if you're one of those competitive startups that is going to raise, continuing with amazing term sheets and stuff, you needed to react very quickly. So I think we are very proud that we reacted in September, October, maybe 6 months before other early stage startups, and that's allowed us to grow very well. So in terms of traction, we've moved from 200 clients to 600. In terms of countries, we were only present in Spain. We are now also in Colombia, Peru, and Portugal. In terms of product, we launched an amazing new feature, which is an employee benefits card called FlexFlow. It allows you to replace meal vouchers such as Edenred or Sodexo, and the traction of that has been amazing. It's already 10% of our revenue. And in terms of the most important thing for a SaaS business that is aiming to raise in the future, our revenue has grown more in the last 6 months than in the first 2 years of our life, right? So overall, very happy. If I could have looked 1 year ago at the situation today, I would have signed it very happily.